Welcome back, everyone. Today on the Joseph Carlson Show, we have a very busy episode full of lots of news. First of all, we have an interview with the CEO of MGM. Now, he has gone through a hack. MGM has been breached. They had to recover from it. It disrupted their business, but he did something unique. He did not pay the people trying to extort his business. He didn't give them any money, so they just fought the hackers and regained control slowly. Now, this is also an important person because he's the CEO of MGM, and MGM makes up for around 40% of VICI's rent roll, and I'm invested in VICI. So in a way, the business that I'm invested in is heavily tied to MGM. So I want to look and see how this company's doing. Now, we have some other big news. The CEO of Unity has stepped down effective immediately. This was completely out of the blue. It's never good news when a CEO suddenly steps down without any prior planning. And this goes back a little bit further. Unity has recently made some dramatically horrible moves with pricing for their games. We're going to go over this business mistake, this PR disaster, and it subsequently leading to the CEO stepping down. And we know every big tech company is trying to make its way into healthcare, and they all have various strategies on doing this. Apple does, Amazon does, but now we have Microsoft making their step into healthcare. The latest news just released today is that Microsoft is announcing new AI tools to help doctors deliver better care. We'll be going into the details of those tools. And then finally, we have some big news on Pepsi. They just released their earnings report, and at a time where people think that we're going into a recession and things are slowing down, Pepsi said, no, that's not what's going on with our business. People are still hungry. They like our salty snacks. They like our drinks. Pepsi's up 2% today because they crushed earnings. So we'll be looking at the commentary of the CEO of Pepsi and what he has to say about the most recent quarter. So obviously we have a lot of news to get to. Let's go ahead and jump right in. We'll start off with this interview from the CEO of MGM. Now, the reason that I pay attention to the CEO of MGM and Caesars for that matter is I own a company called VICI. If we go to my portfolio here, this is my primary portfolio called the passive income portfolio. I track it every single week on the channel Joseph Carlson. Now, the strategy of this portfolio is to concentrate my money into high quality companies, ones that I call compounding machines, ones that will continue to grow in capital appreciation and pay dividends for many years in the future. Now, they have a lot of other traits, but overall, that's what I'm looking for. It's a very concentrated portfolio. I have nearly $500,000 worth of capital in 11 companies. So $500,000 into 11 positions. And I feel comfortable doing that because of the quality of these companies. One of them is called VICI. VICI is a company that I've talked about a lot, so I won't review the entire investment case, but VICI Properties owns a lot of different real estate on the Vegas Strip. And two of their biggest tenants is Caesars and MGM. Combined, they make up for around 70% of their overall rents. Each one of them makes up for around 30 to 35%. So MGM makes up around 35% of their total rent. This is a major tenant, meaning that if you're a landlord, if you own this real estate and you're renting out to different tenants, the ability for the tenant to pay you rent is incredibly important. If they can't pay you rent, you don't collect rent. You can't pay on your debts. You're in trouble if they can't pay rent. So the biggest concern I have for VICI, the number one thing I look at with this company are the tenants' ability to pay rent. That question mark is critical. That's everything. So when I own VICI, I'm not just looking at how VICI's doing, I'm looking at how their tenants are doing. I think that's an equally, if not more important question. Now let's go ahead and take a look at what the tenant has been up to. This is MGM making up again around 30+% of VICI's rent roll.
Okay, so when we're talking about the hack, we've seen the 8K. We know that there is, you said, $100 million financial impact that's likely to be covered by insurance. How much of this is in your rear view? And if it's not totally behind you, when will it be?
Now, they reference right off the bat in this interview that there was a hacking. And if you haven't been paying attention, MGM was hacked recently. In fact, this has been the news of this company over the past couple of months. It's made news headlines in the Wall Street Journal and all over the place. We can look at one of them here. MGM didn't pay up for the hackers who broke into its system and stole customer data. They did more than just steal customer data. They shut down all of their casino floors, made it so people couldn't play the games. They messed with the door locking mechanism so people couldn't lock their doors in their hotel rooms. They messed with the booking so people had to wait in long lines to book. It was inconvenient overall. They even shut down the paid-for parking. So every part of MGM's business was shut down, from booking to the app to the casino floor, everything. Now, after these hackers have gained access to all of the systems and basically shut down the entire business, that's when they try to extort you. They say that we have your business shut down. It's going to cause immense damage reputationally to your customers, big inconvenience and loss, monetary loss for you. And all you have to do is pay us $10 million or $20 million, and we'll give you a key to get everything back to normal right away. In an hour, everything will be back to normal. That's the extortion technique. And that does unfortunately work. A lot of companies pay. In fact, I believe that Caesars, another casino, just recently paid these hackers. Now, this CEO, he chose a different path. He chose not to pay. And I applaud that decision. Even if I was being inconvenienced as a customer, I would still not want him to pay the hackers. That's how much I hate these hackers. I would rather personally be inconvenienced and have lots of problems with my vacation than have him send $20 million to the hackers to get everything back on track. Now, not everyone agrees with that decision, but I hate paying the hackers. So I think it sets a better precedent when you don't pay. You show hackers that we're not an easy target. You're going to waste your time if you hack our business. So that was the background of this. Now, this MGM hacking is still causing problems. They're still trying to recover from it. But as of right now, most things are operational. They've taken the past month to rebuild their entire business.
It is totally behind us. Look, it was a hell of a 3-week period. I cannot but say how resilient we are. I got to call out the MGM employees. They've been nothing but great through this entire process, but this is behind us. Hopefully it's a one-time incident, knock on something quickly, and we're all moving forward. It had a significant impact, as you saw in September. There'll be some lingering impacts in the first part of October, but then the balance of the quarter through Formula One and into December, we think we're in great shape. We sold out over the weekend. We're anticipating mid-90% occupancies throughout October.
But in the meantime,
So he says that there's about $100 million in insurance claim because of this hacking. That's how expensive it was. And if I was MGM or Caesars, I would be talking with companies like CrowdStrike or Microsoft or whoever to implement better security protocols, which I'm sure they're doing right now. They realize the vulnerabilities and they're paying some money now to get better protection from this type of thing in the future.
You're left rebuilding your tech. You have to make sure that the way that these guys got in, which was a human error, a human opening the door and then letting them in, doesn't happen again. And then what has been the impact of the brand disruption?
Look, it's not.
So a lot of ways this hacking works is it's not because of poor encryption or problems with passwords being broken. It's human engineering, where people call in, they pretend to be the CEO. Those are phishing schemes. They pretend to be employees that are important. They fake different emails and they get information to be able to access everything. A way that they can prevent this in the future is by segregating access to different parts of the system. So if you have access to one part of the system, you can't break through to every part of the system like you could with MGM. So I think they need to do a much better job with their permissions and the way that they overall build their system out. Not one person should be able to access everything across the company like this hacker could.
Ideal, obviously. But again, MGM, Las Vegas, our group has been nothing but resilient. If you think about all the things we've been through over the last 4 or 5 years, this is unfortunately one more incident. It is behind us. We're looking forward. There is work to do going forward in terms of restructuring, rebuilding, re-architecting where we were versus where we'd like to get to. But all that's in play. We feel extremely safe and secure where we are today and looking forward to a great quarter, hopefully.
Now, he says that this is mostly behind us, which I actually believe. I was just recently in Vegas for a couple days, and from what I could see, MGM properties were up and running. All their casino floors were running. Everything was going well. I didn't stay at an MGM resort, but from what I could see, it does look like everything was behind them. So I believe him. I think things are back on track. They probably learned a lot over the past couple of weeks, but hopefully they don't have this type of incident in the future.
The American Gaming Association is out with a report about the economic impact of gaming. Really incredible, more than $300 billion annually of economic impact. In Nevada, we're seeing a big influx of convention business. That's up more than 60% last month over last year. So yes, business is booming here.
Now, she just mentioned that the convention space, the convention business is up 60% year over year on the month. So a huge increase and rebound in convention. And this is something that I predicted happening for a while. Convention got completely shut down during COVID. Everything was through Zoom. We couldn't do any large scale meetings. But human beings, we like to meet in person and see things and feel things with our own hands. Vegas has the largest convention space in the world, and VICI is the owner of the most convention square feet in real estate in the world. So I think that VICI, and again, it has prized real estate of the convention business. I believe we're going to continue to see growth in the convention business next year and the year beyond that.
You can tell it. But now you have this threatened strike with the culinary union. Where do things stand with the union, and when does that get resolved?
We're in constant dialogue with them. I'm in dialogue with them. I know the other CEOs are engaged, so we're engaged at the highest level. We haven't had a citywide strike in 39 years. I'd like to think it's in everyone's best interest, our employees, our stakeholders, ourselves, to continue to go forward, continue to discuss. We will get through this. And so it's critical time. I think the next 2 or 3 weeks, hopefully something of substance happens. And we'll get through this like we always have gotten through this. And if you want to look at resiliency, just look at what our company just went through. We're prepared to take anything this brings, but I think we will all prevail. And I think ultimately common sense will prevail here.
So we have another potential strike from 53,000 hospitality workers that represent this big union in Las Vegas. Another potential threat for these companies. But I don't really see it as a threat. I don't see this as a big problem. These hospitality workers work extremely hard. I think they should use their power to try to get better negotiations with the companies. I don't think this is going to negatively impact VICI at all. And they're even one more step removed. I don't think this will impact these companies' ability to pay rent. If anything, it will make it so that the employees are better treated, they're better paid. I think they'll have a more enjoyable job, which leads to better service for everybody visiting. So I don't see this as a negative thing. In my experience too, a lot of the threats of unions has been over dramatized. I've seen the same type of union threat against Starbucks and Amazon and Netflix and so on and so forth. Overall, it typically does not change the long-term trajectory of the company. So even though VICI right now has traded down to $29, and I believe a lot of this is just because of interest rates and macro stuff, I don't think it shows any weakness with the actual company. I think VICI remains one of the easiest companies for me to hold. They're collecting 100% of rents. They have great tenants that we can observe their balance sheets. And another reason the company is easy to hold is, look at this. This is my dividend payments I receive. I get these every quarter. Every 3 months, I get a big pile of cash given to me from VICI. They say that we collected rent. Here's the rent for the month. Thank you for owning this company. That's literally what happens in this relationship. Last quarter, here is what the payment was. $755. So I'm getting $750 every 3 months for doing nothing but sitting there. And the price may go lower. It could always go down a bit, but the company's fundamentals remain incredibly strong. They're collecting 100% of rents. So I have another video planned on VICI where I dive in a bit deeper next week. But as of right now, I don't see anything wrong with this company. Now, moving on, we have the breaking news that the Unity CEO is out. He left the company effective immediately. Now, they say here that he's going to advise Unity to ensure a smooth transition, but that seems a lot like lip service. Typically, you don't have a CEO that leaves a company overnight unless something went wrong. That's the only time I see this happening. Typically, there's a succession plan. The CEO will say that they're thinking about stepping down in the future. They plan it in advance so investors know about it. They don't just suddenly leave. But that's exactly what happened in this position. Now, I believe I know the reason that the Unity CEO is stepping down, and I want to highlight the problem with companies that have poor financials because it pressures a lot of bad decisions. While the press release makes no mention of it, this is happening amidst a giant game industry controversy over Unity introducing a new pricing model and retroactively changing its terms of service, breaking trust with many game developers in the process. They had news articles, and this was everywhere, that Unity was doing this incredibly aggressive pricing structure. Now, to understand why this move was so detrimental and why their pricing created such outrage, you have to understand what Unity actually is. Unity is a company that makes tools for video game developers, specifically the physics engine that runs games. So if you have characters walking around or falling off of things, the physics of those motions, they help develop the framework for using that. And most developers use a framework. They don't build this stuff from the ground up. So especially popular amongst indie developers. They use Unity framework a lot. Now, what this company did was pretty incredible. They changed the price retroactively, and they said that they would charge its customers a fee every time someone installed a game based on the engine. So if you developed your game on Unity's engine, all of a sudden they changed the pricing for your already developed and released games, ones that are already out there making money. And Unity says, hey, for those games, we're now going to start charging around 15 to 20 cents every time someone downloads the game. Whether they play it or not, whether you're charging for the game or not, whether it's a freemium model, it doesn't matter. It doesn't even matter if the same person downloaded the game 5 times. Every download's going to be 15 cents. This generated a quick, angry response across the games industry, and some studios threatened to move to different engines, even if that meant possible delays to new releases. So a lot of them were wanting to build their entire game under a new engine because they broke trust with Unity. So this completely blew up. Every single Reddit forum on Twitter, everywhere, people were furious with Unity. This led to Unity issuing a statement last Thursday clarifying some conditions of its new fees in an attempt to calm the situation and insist the majority of developers would not be affected. And then more recently, they've almost entirely walked this back. They've basically said that we made a mistake and we're going to try to make this right. I believe that the PR disaster and the CEO stepping down are not coincidental. I think a lot of people are very unhappy with his mishandling of this situation. So it could have been for a different reason, but I don't think this is a coincidence. Now, this also raises the question, why? Why would Unity take such an ill-advised move and raise prices retroactively for their developers in such an aggressive manner? And I believe the answer to why they did this ultimately lies within the fundamentals. If we look at Unity here, and we can bring this up on Qualtrim, and on a side note, this software, Qualtrim, is included as part of the Patreon membership. And unlike Unity, I'm not going to break your trust. We won't be retroactively raising prices on Qualtrim. Now, if we look at the fundamentals of Unity, I think this really answers the question of why they were desperate to make money. The company has growing revenue, so that's going okay. Revenue's growing, but look at the financials of this company. Look at the EBITDA. Every single quarter, they have negative EBITDA. So the company's losing money every single month, more and more money. On a free cash flow basis, it's also largely negative. Every single year it's negative. They have a couple positive quarters, but they're met with overall negative quarters. We have negative earnings per share. We have negative net income. We have a company that right now has more debt than they have cash. So every financial metric is negative and they have more debt than cash. This is the opposite of what you want a company to be. On top of that, this doesn't actually show the entire situation clearly, because as we know, the cash flow is not the only expense to the company. We also have stock-based comp. When we look at the stock-based comp, this looks even worse. It looks terrible. The stock-based comp in purple here far exceeds any cash flow they've ever generated, meaning that this company is not only losing cash flow directly every single quarter, but they're also diluting heavily the shareholder. The financials are atrocious. Now, I'm not trying to justify the actions of Unity or say that their pricing mishap was a good move, but I think when a company's under this type of stress, they're trying to make money. They're trying to desperately make money any way possible. And a company that has desperate fundamentals in a financial situation, I think will go to desperate levels to increase their finances, which was what they did with this ill-advised situation. Now, it says here that the stock is trading up 3% because the CEO has stepped down. I don't think that's going to solve their issues. There's reputational damage done, and I see these financials as being awful. Unity is not a company I'll be owning anytime soon. Now, moving on, we have some big news out of Microsoft. We know that all the big tech companies are trying to get into healthcare. Apple's doing it through the Apple Watch and other devices. We have Amazon. They've done a lot of things. Amazon is trying to do better pharmaceutical care, right? Cheaper drugs, that type of thing. Microsoft wants to get into the software side of it, which is exactly aligned with their overall company. They love the high gross margins, 70% or above. They love software. They love subscriptions. So if they can enter into the healthcare market with all of those characteristics, I think Microsoft will do it. In this case, let's go ahead and read what they're doing. And this was information that was presented in the tech conference that's going on in Las Vegas right now. Microsoft on Tuesday announced new data and artificial intelligence products that aim to help healthcare organizations easily access and learn from mountains of information collected by doctors and hospitals. The healthcare and life sciences industry is responsible for generating more than 30% of all data produced globally, according to recent reports from Deloitte. But it can be challenging to leverage all of that information since it's stored across a variety of different systems and formats. Around 97% of the data generated by hospitals remains unused. So they're laying out the issue here. Microsoft is saying 30% of data globally is healthcare related data. 97% of that data goes to waste. Instead of making use of only 3% of the data, we can make use of 100% of the data. To help address this issue, Microsoft said today at the HLTH conference in Las Vegas, it developed a new healthcare-specific tool in Fabric. So I think the tool's called Fabric, if I'm not mistaken, a data and analytic platform the company announced in May. It combines data from sources such as electronic health records, images, lab systems, medical devices, and claim systems so organizations can standardize it and access it in the same place. I think this is a great approach at a product for Microsoft. Taking all this different forms of data, combining it together, making it searchable is something that hospitals desperately need. A lot of hospitals are great at healthcare and treatment. They have doctors and nurses that work diligently there. But if you talk to doctors and you talk to nurses, they will almost always say that the software is awful. That's like a consensus. They all hate the software that they work with because a lot of times there's so much red tape. It's a lot of antiquated software. If Microsoft can start making progress there, it could improve healthcare overall and it can make Microsoft money at the same time. Now moving on, we get to some news that Pepsi just recently released their earnings report just this morning, and shares are up 2% because Pepsi, once again, this company defies expectations. People think that the consumer is struggling, that people are slowing down on spending. Maybe that's the case with some companies. It's not the case with Pepsi. This company continues to grow its revenue and earnings and cash flow. It says that Pepsi reported its third quarter earnings, $2.24 a share, up from $1.97 during the same period 1 year ago. The organic revenue grew by 8% over the same period versus the previous year. Almost 9% organic revenue growth. Organic means that it's growing without acquisition. So just their same products selling more year over year. Pricing in the mix of products boosted revenue by 11%, while organic sales volumes fell 2.5%. I see this as a bit problematic. It's true that Pepsi has pricing power. So the company can raise prices and people still continue to pay for higher prices. But I like to see companies that can raise prices and have more people, more volume, more people use their services. What Pepsi's doing is they're raising prices, but they're having sales volume fall. So less people are buying, but the people that are buying are paying more. They also credit a lot of the performance in their earnings report to a lot of efficiencies and improvements in their business. They're making a lot of positive changes. I like Pepsi overall. The reason that I decided not to own this company or make it a concentrated position in my portfolio is for a couple of reasons. Despite the fact that it's a very defensive company, I think it's going to be around for another 100 years and producing cash flows, the company does have a lot of debt. So that's one thing I don't love to see. We can see the amount of leverage increasing over time. In the past 10 years, you can see it go up. Right now, they have $36 billion of long-term debt and $6 billion in cash. So around $30 billion in excess debt. That's a lot. The other thing that I don't love about the company is it's just a bit too mature and slow growing for my portfolio. I have very concentrated positions. I want companies that are going to vastly outperform. To outperform, you need to have faster revenue growth, faster earnings growth, and faster free cash flow per share growth than the market. And that needs to be sustained for a long period of time. But even so, I think that Pepsi will still outperform to a moderate degree. So I think it will be a very good holding in the future. Now that's going to be it for this episode. I hope you enjoyed. If you like this type of content, make sure to check out the Patreon. We have a Discord community with thousands of members. We have exclusive episodes. And of course, you gain full access to Qualtrim, the watch list, the portfolio tracker, all of that good stuff. You can try that out for free with the link in the pinned comment. But if not, I'll see you in the next one.